Hi, everyone, and welcome to today's webinar. My name is Anna, and I'm with the New Mexico Small Business Development Center. Today, we have Ian Alden joining us, who is an attorney that specializes in business and tax law. Ian will be presenting Taxes Got You Down, Tax Strategies to Get You Back on Your Feet. We will be using the Q&A function to take questions and welcome attendee participation, so don't hesitate to ask us any questions you may have. We'll answer those questions during and at the end of the webinar. Thanks so much for joining us. And without further ado, I'll hand it over to you, Ian.
Thank you very much. Good afternoon, everyone. I'm glad to be back with you today for another webinar. Today, we're going to be talking about taxes and really how to get back on your feet and get around or get through some tax problems. And before we jump into that, I do want to go through a few housekeeping notes. Obviously, COVID-19 hasn't left us. It's still running rampant through the lands, and so it's important now as much as ever that we maintain COVID-safe workplaces. This slide here, a copy of which you can get after the presentation, has a number of useful links to resources for you as business owners and employers to keep COVID-safe workplaces, to maintain best practices, and to comply with various regulations that are, old and new to help get us through this pandemic. So be sure to check those out. Your microphone should be muted by default. If they ever come unmuted for whatever reason, please make sure to keep muted. Make sure your Zoom ratio is set to fit window if it's not already. That's so that you can see everything on the slides. We're going to be using the Q&A function to take questions, and I'm going to be taking them throughout the presentation, so don't feel like you need to hold until the end. If you have a question, just throw it into the Q&A and I will answer it. I'll usually get to the end of the slide and then I'll answer the question. If you do want to hold your question to the end, that's fine. Just make sure you write down the slide number your question relates to. That way I know what to skip back to. You can see the slide number in the bottom right-hand corner of your screen. A few other good webinars, workshops that are coming up in the next couple of weeks. We've got Keeping Your Trade Secrets Yours, Basic Steps to Starting a Business, Defend Your Business Against EEOC and Workforce Solutions Complaints, and E-commerce and Alternative Selling Methods, as well as a number of other great workshops and opportunities I haven't listed here. So be sure to go to the NMSBDC website, nmsbdc.org. You can see all the workshops that are coming up. You can also avail yourself of the other resources the SBDC has to offer. There's no-cost business counseling and loan application assistance, which I'll just say in my own law practice, I don't provide no-cost business counseling. So something like that, it's really huge if you have the opportunity. So make sure you're making good use of the resources the SBDC has to provide. Quick disclosure before we jump in, the materials that we're going to go through and the concepts we're talking about, it's all very broad. I'm hitting this in very broad terms, but I'm not really looking at your unique situation. Everyone's situation is different. It's all unique. So be sure you make good use of your resources, have good tax professionals, reach out to the SBDC for that counseling, and come up with solutions that are tailored to you. This presentation is more meant to give you a sense of what your options might be and give you some ideas for how to approach your own tax situation. So real quick, to break this presentation down, we're going to talk about some of the different taxes and tax problems you can find yourself in, looking at some of the COVID-19 specific considerations. There's some different impacts to taxes because of COVID. We're going to look at who's liable for taxes, because it's really important to understand, is it you, is it the business, is it both? And then we're going to look at different solution sets depending on where you are in a tax problem. I always try and break this down in terms of early, middle, and late stage tax problems. And so obviously being proactive is better than being reactive or having to deal with a crisis, but we're going to look at what your options are in all three of those different scenarios. So jumping right in, tax problems can arise in a number of ways. This is a fun little example because PowerPoint has a few stock images you can choose from, and this payment under the table is a classic example of how tax problems can arise. Obviously not the only way, but there's a number of different ways tax problems can crop up. And a lot depends on the type of taxes we're talking about. People come to me as a practicing tax attorney and say, I've got tax problems. I am being audited for not paying my taxes. And the first question I have to ask every time is, who's auditing you and what taxes are we talking about? Because you've got the income taxes, federal and state income taxes. You've got payroll taxes, which, you've got the employee withholdings, income tax, FICA taxes, Social Security, Medicare, et cetera. You've got self-employment tax, which we'll go through, gross receipts, franchise, compensating, and there's more. I mean, there's the fringier taxes, but these are the common ones that I see people come to me for help with. So, looking through them as a business owner, if you own a pass-through business, which is the vast majority of businesses out there today, you're responsible for paying federal and state income tax on the net business income of the business. That's gross income, less allowable deductions, ordinary necessary business expenses, et cetera. It's the same as with personal taxes. You've got your gross income, you subtract certain things, and then you're left with your taxable net business income. You as the owners have to pay taxes on that if you own a pass-through entity, which includes sole proprietorships, partnerships, S-corps, LLCs, taxed as disregarded entities, sole proprietorships, partnerships, S-corps. If you own a business, there's a very good chance that your business falls into that. If your business doesn't fall into that, it's a C Corp or an LLC taxed as a C Corp, which means that you still have to pay federal and state income taxes. But now we're talking about corporate income tax as opposed to personal income tax. So these are taxes that one way or another, they have to get paid on the net business income of the company, and they're paid to the federal and state governments. These are one of the most common taxes to run afoul of, just failing to pay income tax. I've got a question in the Q&A. Are the months of July, August, and September taxes due on October 25th, 2021? So we're talking, so that question, are taxes for the months of July, August, and September due on October 25th? Okay, specifically for gross receipts tax. It depends on if you're filing quarterly, because you've got, for New Mexico, you've got quarters, January, March, April, May, June, July, August, and September, which would typically be due October 15th. The reporting and payments. I don't have the exact dates in front of me, and I'll be honest, I don't recall the filing dates for gross receipts tax off the top of my head. It's usually by the 15th of the month following the end of the quarter in which the taxes accrue. So if you've got taxes for July, August, and September, you'd report that in October. So that's federal and state income taxes. Like I said, it's just income tax. You pay it at your personal tax rates for pass-through entities. So if you're in the highest marginal rate anyway, and you've got business income, it can be taxed up to 35% federal and then about 5% state. Corporate income tax, if you have a C Corp or an LLC taxed as one, it's taxed at the federal corporate rate of 21%. And then New Mexico, again, is somewhere in the ballpark of 5% for corporate income tax. But those are taxes that have to be paid. Got more in the Q&A? No, that's done. Okay. So after federal and state income tax, this is the boogeyman of taxes. I mean, this is what, if I had to say more than anything else, the tax that causes people the most problems, it's payroll taxes. Your businesses, you're required to withhold payroll taxes from any compensation paid to W-2 employees. Federal income tax, state income tax, Social Security, and Medicare. You withhold the employees' portions of those taxes from their paychecks, and you, the employer, hold that money in trust to pay to the IRS, usually quarterly, if not monthly. Those are called trust fund taxes because the money doesn't belong to you, the employer. You're just holding it in trust for the IRS. The employees are paying it to the IRS through you, and you're holding it in trust. Additionally, payroll taxes include the employer's portion of Social Security and Medicare, because the employee pays half and the employer pays half. That's how Social Security and Medicare works. You hold it all, you pay it to the IRS. If you don't pay it to the IRS, bad things happen, which we will cover in just a few minutes here. But payroll taxes, that's something that pretty much every business owner has to reckon with if you're employing anyone, which might include yourselves if you're taxed as a corporation, an S Corp or C Corp. Owners of an S Corp or a C Corp can draw a salary, and often they have to draw a salary. And of course, it includes any other employees you have. There's self-employment taxes, which if you're the owner of certain pass-through entities like sole proprietorships, partnerships, LLCs taxed as either, you're paying self-employment taxes, which in addition to your income tax, that's basically Social Security and Medicare tax for people who aren't W-2 employees. So you've got to pay self-employment tax on the net business income of the company up to 15.3%. Plus for certain high earners, an additional 0.9%. A lot of people never, ever think about this when they're in their first year of business. They think, okay, I just got to pay my income taxes and it's fine. They forget about Social Security and Medicare taxes, and those also have to be paid. And so typically, as a business owner, you're going to do what's called quarterly estimated tax payments. You're going to pay these things, your income taxes and your self-employment taxes on a quarterly basis. You're going to make a good faith estimate of what they're going to be for the year, and you pay that in quarterly chunks. But if you don't pay those quarterly, you don't pay them at the end of the year, when it comes time to file your taxes for the year, you're going to have problems with the IRS, which again, we'll cover later. You've got gross receipts tax, which is probably the third biggest tax problem that folks have, because no one understands what gross receipts tax is at first. It's a very weird tax. I will be frank with you. Gross receipts tax is why we rate so low nationally in terms of business friendliness. It's because it's a very complicated thing to wrap your head around if you're from out of state. Most states have a sales tax, which is a tax that the state charges the buyer of goods and services. You go buy something in a state with a sales tax, it's a tax imposed on you, the buyer. The seller collects it on your behalf and they pay it to the state. It's considered a trust fund tax because it's just money from the buyer that the seller is passing on to the state. All is well, nice and simple. It's a tax on the buyer. If the buyer is tax exempt, there's no sales tax. Nice and simple. New Mexico complicated things pretty dramatically with the gross receipts tax. It's our equivalent of a sales tax, but it's a tax imposed on the seller of goods and services. So you, the business, when you sell something, it's a tax on you. You can pass it on to the buyer in the form of an additional surcharge, but it's a tax on you that you have to pay to the state, even if you don't collect it from the buyer. If you don't collect it from the buyer, you're still responsible for paying it. And that throws so many sellers for a loop in this state. The rates vary depending on your locality. They run from 5.5% to 8.5%, depending on where you are. You pay it monthly, quarterly, semi-annually, or annually, depending on your gross receipts, but it's something that you have to collect and pay to the state. There's franchise tax, which is very often overlooked. We've got a question about, I think, gross receipts taxes. Okay. I've got another question. I have an LLC and take owner draws when needed. Should I pay it at the end of the year? I'm going to go out on a limb and assume if you're talking about owner draws, you're the only owner of the LLC and that it's treated as a disregarded entity or sole proprietorship, which means you're just reporting all the profits and losses on your personal tax return. You're using Schedule C and you're just doing it that way. So to answer your question, yet one owner. So to answer your question, you should be making quarterly estimated payments. You should try and figure out, and you typically use previous year's revenue as a minimum estimate, but you try and estimate what your income is going to be for the year, what your tax liability will be based on that income, and then you pay that in quarterly installments to the IRS and to the state. That's typically how you would do that, because keep in mind, when you take owner draws, it doesn't matter. You're taxed on the income of the company, even if you don't take an owner draw. As soon as the company receives that income, it becomes taxable income to you, the owner. So you need to be reporting it and paying taxes on at least a quarterly basis. But if you don't do quarterlies, then you certainly have to report that income at year end on your annual tax return. And I'd recommend having a good accountant or CPA or tax preparer who can help you with all that. But we've got franchise taxes, which are taxes imposed on a business for the privilege of existing. S corps, C corps, and LLCs taxes them have to pay franchise taxes. They're negligible. They're like $50 a year in this state, but it's a tax that's often overlooked, and the state can get a little irritated if you don't pay them. So if you have an S corp, a C corp, or an LLC taxed as them, you typically have to do the franchise tax to the state in a separate return each year. And then finally, we've got compensating taxes. This is New Mexico's version of an excise tax or use tax. This is one of the most overlooked taxes in the state. I gave you the full definition in this slide so that you can understand how convoluted the concept is, but basically it's a tax that you have to pay if you use property or services in New Mexico that would be subject to gross receipts tax, but for the seller of the goods or services being based out of state. It's complicated and very often overlooked. And typically the state isn't very aggressive about compensating taxes unless it notices a delinquency in some other form like gross receipts tax, or if you're doing something that just puts you on their radar. It's really hard for the state to track compensating tax delinquencies without some other cause for an audit. But just know that this is a tax that exists, and I recommend that you keep up with it. The best way to do that is have a good accountant or CPA who can go through on at least an annual basis and make sure that you're keeping up with your compensating tax obligations. So those are the basic taxes. It's a lot, I know, but if you're getting audited, for example, or if you are if you have tax problems or you think you have tax problems and you want to look for solutions, you have to understand what the different taxes are, because you can't just say, I'm delinquent on my taxes. It's not that simple, because, and I'm going to talk about this in a second, who's liable for those taxes depend on the type of taxes. There are some taxes that pass through to the owners and the owners are liable for, so you can't really escape them. There's some taxes where if you fall behind and the business just goes under, the taxes can die with the business. And so it's really important to understand who's liable, which requires you to understand what the tax is. Before I jump into who's liable, I want to talk a little bit about COVID-19, because obviously that's upended the whole tax system, the whole dynamic of taxes, because a lot of taxes were deferred at the federal and state level. And then there's a lot of COVID-19 related programs that require special tax filings. For example, a lot of my clients took advantage of the option to defer payment of self-employment tax deposits. The IRS basically said, as an act of Congress, if you owe certain self-employment tax to the IRS, you can defer it. You report it on your 2020 tax return, and then you pay 50% of the deferred amounts by the end of 2021, 50% by the end of 2022. A lot of my clients took this option, took the deferral, and then forgot about it. Do not forget about it, because 50% of the deferred amounts are coming due at the end of this year, and the other 50% are due at the end of next year. And we're not talking like, pay it by April 15th of 2022. We're talking pay it by December 31st of 2021. So make sure to pay that if you took the deferral. I get a lot of questions about PPP loans and taxes. The PPP loans aren't considered taxable income even if forgiven, but expenses paid from the PPP proceeds may still be deductible as ordinary necessary business expenses. So this is, a lot of folks are leaving a lot of money on the table Make sure that you're taking the proper expense deductions. And again, this goes back to having a good accountant, CPA, or tax preparer who can help you. But make sure that you're not leaving money on the table with the PPP loans. So that's a quick deviation just to talk about some COVID considerations, but jumping back into the tax problems, we have to look at who's liable for taxes. So the business, the owners, or both. Because, you know, if it's the business and it's just the business, then maybe if you have tax problems that are just overwhelming, you can let the business go under and leave the tax problems with the business. But a lot of tax problems follow the owners or belong to the owners in the first place. You know, and then some tax problems can pass from the business to the owner. So let's look at that. We talked about federal and state income taxes, right? And we talked about the owners of pass-through entities. It's the owner's problems. The owners are individually responsible for reporting and paying income taxes on their respective share of the net business income. So if you have a 50-50 partnership, for example, or an LLC taxed as a partnership with 50-50 split, or an S Corp, or an LLC taxed as an S Corp with 50-50 split, each of the owners is responsible for 50% of the income taxes on the net business income of the company, right? It's a 50-50 split. So the owners are going to be paying the income taxes at their personal, federal, and state rates. That's just an obligation that belongs to the owners in the first place. It never belongs to the company. And a lot of folks get confused about this, thinking, oh, the company is going to pay my taxes on that. It's not on me. You, the owners, are responsible for your share of the taxes of the income as soon as it's received by the company. So whether or not you take an owner draw or an owner distribution, it's on you. For corporations, for C Corps and LLCs taxed as C Corp, it's the corporation that's responsible for reporting and paying corporate income taxes on the net business income. So depending on how your company is structured and taxed, that determines who's responsible for the taxes. But you know, you look at C Corps and LLCs taxed as them, those tax liabilities can pass through to the owners. So they don't by default, but if the owners are not paying the corporate income taxes on the company and they're taking all the money out personally, the IRS and the state have ways to claw that money back. They can go after the owners to get the money that was paid to them instead of to the IRS or to tax and rev. So just know C Corps aren't a great way to evade income taxes at all. So yeah, that's income taxes. Payroll tax. This is the boogeyman because payroll tax, it's initially on the business to pay them. The business collects the money from the employees, it holds the money in trust, it pays the money to the IRS. Because these are trust fund taxes, it's money the business owner was never entitled to keep in the first place. The IRS is extremely aggressive in pursuing these taxes. If you, the owner of a business, withhold money from the employee's paychecks and you fail to pass that on to the IRS and you spend the money, the IRS will not only go after the business, but they will go after every owner and other party who they feel was responsible for withholding and paying the money, but failed to do so. It's called a trust fund recovery penalty. And so they'll go after the business and those owners at the same time. So it's called joint and several liability because they will try and collect from whoever they think has the resources. So if you've got business owners and you've got the business that's insolvent, they're just going to ignore the business and go after the business owners. I mean, they'll go after everyone, but they will focus aggressively on the owners. So, you know, I've had people ask me, like, I don't have the money to pay my income tax, payroll tax, and gross receipts tax right now. What do I prioritize? And, you know, I can't tell you don't pay your taxes, but if you have to prioritize payroll taxes, you have to pay. If you don't pay the payroll taxes, they will go after you personally. You can't discharge the debt in bankruptcy. They'll go after your house, your bank accounts. They're very aggressive. So pay your payroll taxes, I implore you. Self-employment taxes, these are just like income taxes, and they're unique to the owners of pass-through business entities. So you pay them much the same way you pay your income taxes. They're borne by each owner of the business. You pay them quarterly along with your income taxes. You report it all on your personal tax return at the end of the year. It all passes through to the owners. So this is a tax that's borne by the owners. It's never the responsibility of the business. Gross receipts taxes. This is uniquely a responsibility of the business. So unless you're operating as a sole proprietorship, which means you don't have a business entity, you don't have an LLC or a corporation, you're just running a business in your own name, or you've done something horribly wrong where you've commingled the assets, or your company isn't real, it's just kind of a sham or something like that, where tax and rev or the IRS or tax and rev in this case can go after you personally. Unless you've done something like that, the tax belongs to the business. It doesn't pass through to you. So let's say you've got a business. It owes a bunch of gross receipts tax. You've run the LLC properly. It's an LLC and you've run it properly. No grounds to pierce the corporate veil, but you failed to pay the gross receipts tax. The tax debt has become overwhelming. The business isn't doing well. You shutter the business. If you've done everything like that and there's no grounds for them to go after you personally, the tax dies with the business unless you start a subsequent business. If you start what's called a successor business, or you sell the business assets to someone else who starts a successor business, if you do one of those things, the taxes will follow to successor businesses. But what gross receipts taxes typically won't do is pass to you as the owner of a business, unless you do something like you sell assets of the business to yourself or something like that. If you just let the business fail, and then you close up shop, you declare bankruptcy for the business or whatnot, the gross receipts taxes stay with the business. That's by and large the rule. So just understand, if you've got gross receipts tax problems and only gross receipts tax problems, your solutions might be a little different than if you have income tax problems, which are going to be very different than if you have payroll tax problems. So this is why I say the type of tax really matters. Franchise and compensating taxes, these are taxes that the business is predominantly responsible for. I think there may be some edge cases where compensating taxes can pass through to the business owner, but that's kind of the exception to the rule there. So now, and I know this is like drinking from a fire hose, but I've gone through the different types of taxes. I've gone through who's liable for those taxes. Now that we've gone through that, let's start looking at solutions. And again, the type of solution that might work for you depends a lot on where you are in the process. And I'll give you some examples here. Let's say you have gross receipts tax problems. The first thing Tax and Rev is going to do is they're going to send you a letter saying, hey, we have identified something that we believe to be a delinquency. You have 10 days to reach out to us, chat with us, go over what we think is the problem. If we don't hear from you in 10 days, we will issue you a formal assessment for what we have identified as the delinquency. After that formal assessment, you have 90 days to protest it. If you don't protest it, it becomes finalized, and then we will begin collections activities. Do you see where I'm going with this? The sooner you address tax problems, the better off you're going to be and the more options you're going to have. And the types of solutions that are available to you really differs based on how proactive you are, because the most proactive way to address tax problems is before the IRS or Tax and Rev identifies them. And so that's what we're going to talk about first. We're going to talk about proactive solutions that you can use before the IRS or Tax and Rev comes out of the woodwork and identifies a problem. So let's say you're talking to a friend, which is really how a lot of these things are identified. You're talking to a friend who's telling you about their tax problems. Tax and Rev audited them and said, you were supposed to be paying gross receipts tax this whole time. Now the friend is going to have to pay a bunch of back taxes and penalties and interest. And you think, oh, wow, should I have been paying gross receipts taxes this whole time? The answer is maybe. And so before tax and rev comes after you, you can identify and use one of these solutions. Same with the IRS. If you think, wow, I've really been, misunderstanding what net business income is, or maybe I took these deductions on hindsight, I'm really not entitled to, I should probably fix that. And you can. You can be proactive and fix these problems before the IRS or tax and rev starts coming after you. And here are some ways you can do it. Whoops. The first way is what I like to call a self-audit. You hire an accountant or a CPA. I usually strongly lean on CPAs, and I don't mean to knock accountants who aren't CPAs, but CPAs, they typically have minimum education requirements to become a CPA. They've got experience on the job, practical experience before they can take the CPA exam. They've got credentialing and licensure and continuing education requirements to stay a CPA. So I lean on CPAs over other accountants, but other accountants may be great at what they do. So find one who works for you. Have your books and tax returns evaluated going back to, and this is really key, if you're going to do it, don't do it halfway. Go back to either the start date of your business or the maximum statute of limitations period, whichever is earlier. Gross receipts tax, you're typically going back 7 years. With the IRS, you're typically going back somewhere between 3 and 6 years, just depending on how badly you've underreported. So go back as far as the statute of limitations period allows. That way, you can't fix, for example, the last 2 years with amended returns, but then have the tax authorities come at you for the other 4 that preceded. Just get it all done at once. Have your books, your records, your tax returns evaluated, and then amend them as necessary. You file amended returns with the IRS or tax and rev. You pay the delinquency, you pay any penalties and interest that may have accrued, and that's it. No muss, no fuss. The IRS typically doesn't come at you if you're amending the returns and paying more than you previously did. It's another story if you amend the returns and try and claim a refund, depending on what you're doing. The IRS might get a little irked, same with tax and rev, but if you're amending and paying more, they're happy. Another way to do a self-audit is what's called a managed audit. Tax and Rev offers this program. It's basically a mea culpa. By self-reporting to Tax and Rev before they come after you, if you qualify, and they've got a standard sheet for managed audits. One condition is you can't already be in an audit, but if you qualify for managed audit and you engage the process, you basically self-audit anyway. You go through, you identify what the errors were in your previous submissions, or if you didn't submit at all, I mean, you do tax returns. You present them to Tax and Rev, they look it over, they typically just nod their head and say yes. Sometimes they'll push back a little, but you come to an agreement with Tax and Rev on what the underlying tax debt is. And once that's agreed, you typically have up to 180 days to pay the tax debt. And if you pay it in full within 180 days, you pay the tax debt without having to pay penalties and interest. Because Tax and Rev can go back up to 7 years for gross receipts tax and audit, the penalties and interest that accrue over that period of time can be huge. I mean, they can be as large as the tax debt in some cases. And so, it's a huge savings depending on how far back your tax liability goes. But the important thing to understand is you have to be proactive with managed audits because you can typically only enter into one before Tax and Rev reaches out to you. With the COVID-19 short staffing, that's been a little different. They've been reaching out to people saying, hey, we think you may have a problem. Do you want to do a managed audit before we do this ourselves? And so that's been a saving grace for a lot of people through COVID-19. I have to imagine that's going to end soon, and they're going to go back to their previous practice of just auditing you. And so, again, managed audit, it's a great way to be proactive in fixing a tax debt. And lastly, establish best practices, because if you're going to be proactive going forward, not just going back. Figure out what the shortcomings were in your system and then fix them going forward so that you don't have to keep doing this year over year where you have to go back and make corrections. If you have good CPAs, payroll service providers, they're going to help you get in the good habits of doing your tax returns properly and timely and paying what's owed when it's owed. Payroll service providers are actually huge here. Because with payroll taxes especially, I can tell you for our own firm, we use a payroll provider, they're local, and they withhold the proper amounts from the employees' paychecks. They file the 941s, they file the quarterly employment tax returns, and then they pay that withheld money directly to the IRS and to tax and rev. We never touch it, our firm. And so there's never that temptation to say, ooh, it's kind of a rainy day, revenues are slow, maybe I'll spend this and I'll make it up before it's due to the IRS. None of that. And so use good payroll service providers because they can take care of a large part of that for you. So you never fall into the trap of being delinquent in payroll taxes because, like I said, they are very aggressive in pursuing those. But, life happens. Sometimes, you weren't as proactive as maybe you should have been. And now they're knocking on your door saying you owe taxes. Or they think you owe taxes. There's got to be some solutions, right? And there are tons of solutions as long as you are being diligent in responding. Because as I pointed out with that letter from Tax and Rev, things can snowball the longer you ignore them. An unanswered audit, for example, if they're auditing you and you don't answer their inquiries in an audit, they're just going to go ahead and do an assessment. Once they've done the assessment, it's really hard to push back on errors in their numbers and their figures. You have to do formal protests at that point if you haven't gone through the audit process in good faith with them. Once you have an assessment, like I said, it's harder to push back on it. And if you ignore the assessment and you don't pay it, it can result in collections efforts. Unanswered collections efforts, if you ignore the collections, they get more aggressive. They can start levying your bank accounts and they will drain those bank accounts into the negatives. I see it all the time. They'll levy your bank accounts, they'll put liens on your home. And if you ignore them past that point and you're really gone to ground, they can try to foreclose on your home. At the very least, they can prevent you from selling it, but in some dire circumstances, they can proceed with foreclosures. And so the longer you ignore your tax problems, the fewer solutions you have to dealing with them. So let's say you're at this point. They've reached out to you. They've said, okay, we think you've done something wrong. This is how we're going to proceed. Engage quickly. Hire a tax professional early in the process. As soon as you get that letter, don't sit on it for 9 out of 10 days because, if you come to me on day 9 or day 10, there's a good chance I can't help you in time, at least in time to make use of that 10-day window. Then we have to deal with, okay, we're in the 90-day window. We can't resolve these things informally. So now we have to do a real protest. And it gets more expensive for you and more complicated, and you get diminished returns. So hire a tax professional early in the process. And that means a tax accountant or a tax attorney, a CPA, a good accountant who has experience with taxes. I cannot emphasize this enough, and I would shout it from the rooftops if it were allowed. This does not mean find a bookkeeper or a family friend. No disrespect to bookkeepers, but their experience, their wheelhouse is limited to making sure that you are keeping up with tracking the receipts and the income and the expenditures of your company. They're not tax professionals. And any bookkeeper who tries to be a tax professional, if they're not an accountant, should go through the process to become an accountant or at least get the requisite tax education, because this isn't something that you learn from experience. There's an educational component, and I have so many clients who've been burned by bookkeepers who tried to learn how to become accountants. It's just not something that you want to deal with. And so if you've got tax problems, go to a tax accountant a tax attorney, someone with tax experience. Have them intercede on your behalf. You know, if the IRS or Tax and Rev sees you're represented by counsel, I speak from experience. This isn't self-promotion. This is just an honest truth. They are more willing to work with someone other than the taxpayer. If they see that I'm involved in the case, they know that I understand the tax system, they know that I can follow deadlines, and they know that I will engage in good faith because it's my professional reputation on the line. I'm not going to suddenly ghost them. So they're willing to work more with a tax professional who can get collections stopped early, who can review what they're proposing, the IRS or Tax and Rev, and say, okay, this is right based on the law, I'll tell my clients, or no, you're dealing with incomplete information. Here is what you should actually be assessing. You know, it just smooths the wheels, it greases the wheels. So engage a tax professional. Don't ignore the deadlines. Again, you know, the deadlines are there. And once you're past a deadline, you're past a deadline. It's really hard to go and ask for forgiveness once you're past a deadline. So, you know, be reactive, be quick about it. Engage the tax professional early, engage in good faith with the tax professional, with the IRS, with Tax and Rev. A lot of people feel very strongly that they shouldn't owe taxes, even if they do owe taxes. There's a philosophical line of thinking that taxes are too high, they're too burdensome. I'm not here to disagree with any of that. My job is to help people through the process and make sure that they don't have their home seized or their bank accounts levied. Make sure that they get onto a good track that gets them out of tax problems. So engage in good faith, even if you hate the tax system. That's just what you have to do. Do your own math. And you know, you can lean on your accountant or CPA to do the math. I do. I very rarely do the math for my own clients because I'm not an accountant. My experience lies elsewhere in the tax realm. So a good CPA or accountant is your best resource here, but don't just take for granted what the IRS or Tax and Rev is saying you owe, because they're dealing with very limited information. For example, Tax and Rev, when they're assessing gross receipts tax delinquencies, they will use your federal Schedule C as the first source in finding a tax delinquency, even though what's on your Schedule C is often way more than what the gross receipts liability is, because you've got so many different deductions and exemptions that you can claim for gross receipts taxes. So do your own math. It's just very important, because then you know what you do or don't owe, and you're not trusting in the math of Tax and Rev or IRS. But, you know, oh, this one is also very important. If you owe the debt, you're going to have to pay the debt. I'm not a sorcerer. I can't make a valid tax debt go away, except in rare instances with the IRS where an offer in compromise is appropriate, or if you go the bankruptcy route and you have a dischargeable debt. Otherwise, I can't make the tax debt go away, but what I can do is help you to negotiate manageable installment payments, which can be up to 72 months. And there's a reason for 72 months, and that is the IRS and Tax and Rev have limitations on how long that they can try to collect tax debts once assessed. You know, they have in some cases up to 10 years, but 72 months, it's enough that, you know, after assessing the debt going back a certain number of years, they can still try and collect if you default on the installment agreement. So we can set up to 72 monthly payments to pay the tax debt. You're going to have to pay penalties and interest during those installments. You know, they're going to continue to accrue. So it's best if you can pay your tax debt in a lump sum or in fewer installments, maybe a year or 2 years instead of 6 years. But one way or the other, if you owe the debt, figure out how to pay it. So that way you can get out from under the hole that you're in, or out from the hole you're in. And lastly, negotiate when it makes sense. And a lot of folks don't really understand this, but tax and rev is legally bound by our Constitution not to negotiate and compromise valid and certain tax debts. There's some wiggle room where there's a legal question of whether the tax debt is really owed. If there's that sort of doubt, the tax and rev can negotiate, but otherwise they can't and won't negotiate. So if you owe gross receipts taxes or if you owe state income taxes, they're not going to be able to negotiate that down. All they can really do for you is come to an agreement on an installment plan. The IRS, however, can and will negotiate in some cases. There's a process called an offer in compromise, which is for taxpayers experiencing significant financial hardship that isn't likely to end in the near term. And so the IRS will look at your financial picture, weigh it against the tax debt and say, okay, we acknowledge your financial hardship. We don't think you're going to be able to get out of it. And making you pay the tax debt in full is going to further exacerbate that financial hardship. So we will let you pay, let's say 60% or 50%, or in some rare cases, I've gotten it down to zero. I've actually gotten a tax debt down to 0% for a client who was permanently disabled, and her quality of life was so bad that the IRS just couldn't bring itself to collect. The offer in compromise was accepted and they waived the tax debt. It's only available in certain tax debts, so you're not going to be able to do that across the board for everything, but it's worth looking into because maybe, just maybe, you can reduce your debt some. But now we're past that. Let's say that ship has sailed. You've really sat on this. The notice period came and went. The assessment period came and went. You're deep into collections now. And this is where most of my phone calls come from. Folks have waited and they've gotten what's called a notice of intent to levy from the IRS. That is the IRS saying, we've given you X number of opportunities. You haven't engaged with us. We are going to go after your bank account. We're going to go after your property. We're going to go after your house. Most of the folks who call me, the letter says, you have until this date to get back to us or we're going to do this. And they call me the day before. Let's say you are in that boat. Do you still have options? Yes, you do. They're not great, but you still have some. So let's look at them. The first option is what's called currently not collectible status. This is a temporary stay on their collection activities if you have financial hardship. There's a lot of disclosure that needs to be done to demonstrate financial hardship. So I usually need at least a week to prepare this kind of paperwork. I can do it in a day or two if I've got the bandwidth, but you don't want to wait until the last minute to push for CNC status. Again, the eligibility is based on financial hardship. So the IRS is going to review your situation. They'll deny it if they believe you can make monthly payments. If they think you can make monthly payments, you're going to have to go forward to the next step of negotiating an installment agreement before they'll stop collections activities. But otherwise, CNC status, if you've got the financial hardship, it'll get you out of making monthly payments. It'll get you out of collections efforts until your financial hardship is abated. The IRS will check in from time to time. You have to renew CNC status every so often, so you can't just sit on it forever, but it's a great way to get out of those sorts of problems in the moment. The next thing you have to do is negotiate an installment agreement. CNC status won't last forever. It's often denied if you don't have the financial hardship or if they think you can make monthly payments. So let's say you're looking at a notice of intent to levy. What can you do? Reach out to the revenue officer who's listed on that notice of intent to levy, or again, hire a tax professional who will do that for you. That's one of the things I do. If you reach out to them and say, oh my gosh, don't levy me, let's sort this out, I'm willing to pay the tax debt, they will usually hold off on the levy And they'll say, okay, you need to provide me this information by this date so that I can review it and we can figure out what your monthly payments will be. They'll also insist that you file any delinquent tax returns. So if you haven't filed for the last couple of years, they'll require that you file before they'll agree to an installment agreement. And this is a really good thing because you don't want to negotiate an installment agreement, have a bunch of unfiled taxes, and then have a whole separate assessment and audit down the road. You want to rope every tax debt back through the statute of limitations into a single installment agreement. What typically happens is you start making payments on an informal installment plan while you finalize the paperwork for a formal installment agreement. That'll start a week or two after you reach out to the revenue officer. They'll say, okay, while we work out the formalities of an installment agreement, you're going to need to start making payments of X number of dollars a month. You do that, you make those payments while you work out the paperwork with the IRS for a real installment agreement, and then you enter into that installment agreement, and then you're on that track. Once you've done that, and the installment agreement is formalized, the IRS takes your account out of the basket, what they like to call it, of the revenue officer and out of collections. That's it, you're out of collections. They're not going to levy, they're not going to lien. Well, they might still have a lien on your property until the debt's paid, but they're not going to levy your bank accounts. They're not going to take additional actions to collect. They're not going to garnish your wages, etc. So an installment agreement is a great way to get out of those sorts of collection scenarios. But what if you don't owe the taxes in the first place? You've waited and you've waited and you've waited and you sat on it, but you don't actually owe the taxes. Then you might need to contest it. You can file a tax protest. The protests look very different depending on the type of taxes at issue and how long you waited. And again, this is where being proactive counts, because if you don't owe the taxes and you say that from the very get-go, and you make your case like within the first 10 days for gross receipts taxes or within the first couple of weeks for IRS taxes, and you can convince whoever is assigned to your assessment, then great. It's just no more complicated than that. You can fix the assessment that way. Let's say they don't agree with you or they make an assessment. You can do a protest without having to pay the taxes if you do it quickly enough. But if you let things go too long, you may be required to pay the alleged tax debt, petition for a refund, and then protest it that way. So I cannot stress this enough about being proactive, but even if you let things go to the very last minute, there's still ways to contest an improper tax debt if you can afford it. And so that's just kind of the rub there. Be proactive or things get more costly. And then finally, and this is a big question I get a lot, and this is one of the most complicated questions I get because the intersection between bankruptcy law and tax law is so weird, for lack of a better term. But there are some cases where tax debts are dischargeable through bankruptcy. And obviously, if you get to that point, you're typically looking at a Chapter 7 liquidation bankruptcy. Sometimes you might be looking at a Chapter 13 or a Chapter 11, but often it's Chapter 7. So let's consider this. Income taxes and gross receipts taxes can be discharged in certain cases. Payroll taxes and fraud penalties cannot. So if you have delinquent payroll taxes, you cannot lose them in bankruptcy. You might be able to stay collections through bankruptcy, but you can do that just as well through an installment agreement. But some taxes, like income taxes, if you filed the tax returns, you can discharge them in bankruptcy as long as the tax debts are at least 3 years old. You can't have a tax debt that's brand new and then go bankrupt and discharge it because there hasn't been enough time for you to try and pay the debt and for the IRS to try and collect it. But let's say the debt's dischargeable, then great, you can go through the bankruptcy process and get rid of the debt. If it's not dischargeable, bankruptcy might still help you. And here's a few examples of that. Let's say you can't negotiate an installment agreement with the IRS because the payments that they want are just too high. Again, you can only make up to 72 months of payments. Like the payment agreement can't be more than 72 months. And let's say that the tax debt divided by 72 dwarfs your income. There's something called a Chapter 13 bankruptcy, which is what's called the wage earners plan. That's what it's informally known as. You pay basically all of your net disposable income into the bankruptcy trust to be paid to your creditors. So, you know, you look at what your net disposable income is each month, you pay that to the bankruptcy trust, it gets paid out to the IRS or tax and revenue creditors. How might this help you? It could help you if your net business income each month is less than what the tax debt divided by 72 is. It would let you pay up to your net disposable income, and it would stay collections activities in the meantime. So the IRS and tax and rev couldn't garnish your wages, they couldn't levy your bank accounts. While you're in a Chapter 13 plan, you're making structured payments, even if you're not getting a tax debt discharged in the other end. So bankruptcy can be used very strategically in this case. And so it's worth considering as a last ditch option, and I implore you, don't let it get to that. Utilize your resources, because the more proactive you are in dealing with your tax problems early, the easier it is to dig yourself out of the hole and get yourself to a more stable place without having to resort to drastic measures. I've got another question in the Q&A. If I change my business name, but I still have the same EIN, will that be an issue in paying my taxes quarterly? The answer is no. You can still make your quarterly tax payments. You'd still make them under the same EIN. And because your LLC is treated as a disregarded entity, as I understand it, you're just reporting everything under your Schedule C personally each year, no matter what the name of the business is. So it'll all come out in the wash at the end. You just need to make sure you're still making the quarterly payments. So do I have any other questions here? We're near the end of a presentation, but I want to make sure that I'm making enough time for everyone to get their questions heard. If you have anything, throw it out in the Q&A, or feel free to raise your hand. If not, I'm going to give you one last little tidbit of advice on gross receipts taxes. I mentioned the successor in business thing. It comes up in two separate contexts. Again, the taxes for gross receipts tax, they stay with the business unless either you, the owner, start a subsequent or successor business. Then tax and rev will go after the successor business for those taxes. They'll just follow along with whatever business you start. The other way that they can pass is through an asset transfer or sale. Gross receipts tax is attached to the assets of a business. And so if you sell the business in an asset sale, the buyer takes those gross receipts taxes. So it's very important for buyers of businesses to understand that those taxes can pass through to them if the previous owner didn't pay them, even in an asset sale. And of course, with a stock sale of a business, any tax debts of the business pass through to the buyer because the business itself is just changing hands. So these tax debts, it's really important to keep on top of them, especially in a buy or sell context, but even personally, like I said, make use of your resources, don't let things spiral. And so I think that's it. I do want to remind everyone about the great resources the SBDC has to offer. Again, there's no cost business counseling, loan application assistance, and other things. If you're not sure where you stand on taxes or anything else, I'd really recommend a no-cost business counseling session, because if nothing else, they can point you in the direction of good financial or tax professionals. They've got a great network throughout the state. It's not just Albuquerque. The SBDC is statewide, so they can give you some helpful resources that are local to you. So definitely make sure to avail yourself of that. Thank you everyone for attending this seminar. I appreciate your attendance, and we look forward to seeing you at the next one.
Thank you so much, Ian, for all the valuable information, and thank you all for your attendance, and we will see you next time around. Thanks again.